So good morning and good evening to everyone who's joined us today. And welcome to today's webinar titled De-risking through Disclosure, Why Emerging Market and Developing Economy Corporates Must Prioritize Transition Planning. I'm Shantanu Srivastav. I'm the research lead for climate finance and climate and sustainable finance research at IEFA South Asia. And the session is co-hosted by IEFA, the Institute for Energy Economics and Financial Analysis, a global energy finance think tank committed to accelerating the transition to a diverse, sustainable, and profitable energy economy, and by Octus ESG, a global expert advisory firm advancing sustainable development and the climate transition, operating at the intersection of finance, investment, and sustainability. Now, before I hand it over to my colleague Alistair to give an opening presentation, I'll just quickly walk you through the session structure and explain a few housekeeping rules. So we'll start with a brief context-setting presentation by Alistair, who's going to talk a bit about the importance of corporate climate transition planning for EMDs. This will be followed by a 60-minute moderated panel discussion with our speakers, which is divided into two key themes. The first section will talk about the role of transition plans and risk management and capital access, while the second section will be about strategic value of transition planning and overcoming implementation barriers. We'll then open the floor for a Q&A session for around about 10 to 15 minutes. So please feel free to post your questions in the Q&A box and we'll address them during this discussion. And as you might have noticed, this session is being recorded. And with that, I'll now hand it over to Alistair to begin the presentation. Over to you, Ali.
Can you hear me now? Okay, I think I'm in the room. Hopefully you can all see my screen now. So let's get on. So yeah, thanks, Shantanu, and again welcome everyone to today's session. And before I pass the torch to Namita, who'll be running today's panel, yeah, I'd like to firstly try to frame today's discussion a little by talking about why transition planning is so critical, but particularly why that's the case in emerging markets and developing economies. So firstly, now the background to all of this really is, of course, the fact that climate risk is financial risk. And as can be seen here on the first chart on the left, economic damages are already starting to mount up. We've seen a massive acceleration in physical damages just over the last 10 years alone. If you look at the green line on this chart, you can see that this is the 3-year moving average of global climate-related damages. We can see how this is almost trebled, in fact, more than trebled in the span of just a decade. So, and I think last year was actually the first on record where total damages exceeded $400 billion. Now, that is physical economic damage, but both physical and transition risk is starting to creep into debt pricing, and investors can expect portfolio values to be suppressed by as much as almost 50%, according to a recent EDHEC study, which you can see on the right-hand side here. Now, bearing in mind that climate change doesn't really care where these emissions are coming from, if we're going to fix this problem of financial damage, where should we be looking? And I guess, judging by the title of the panel, and you may have guessed that emerging markets and developing economies really is where we need to be focusing. That's because this is where energy demand is likely to grow the most, and so that's where emissions are most likely to grow the most. And that's really down to the fact that there's rapidly industrializing economies, there are growing populations, and the populations are becoming increasingly urbanized. So let's focus in on EMDEs a little bit then. So, I mean, as usual, in order to fix the problem, we need to throw some money at it, but how much exactly? Now, this chart will be familiar to some because it details what's referred to as the EMDE transition finance gap, or if you put it another way, the amount of additional money that's needed to achieve either sustainable development scenarios or outcomes, or indeed net zero emissions outcomes. So if we step into it, the amount that the IEA predict that we'll need per year for clean energy funding in EMDEs alone by the 2030s is going to be somewhere in the region of $2 to $3 trillion. Now, this chart is getting a little bit long in the tooth, so I've added on where we expect to be by the end of this year. And we have seen a slight uptick in the amount of funding that EMDEs are receiving, but still it's way below where it needs to be. And what this means is that we're going to see a funding gap of around $1.5 trillion compared to today. So that's somewhere in the region of sort of 1.2 to 1.8, but if you split the difference, it's around about 1.5. Now, what is interesting to note is that half of clean energy financing comes from private or international public sources. But going forward, the IEA predicts that to achieve net zero, this is going to need to change. It's going to need to be closer to around about 2/3 or 66%. So I guess firstly, that means that private capital is going to be essential and it needs to grow in the proportion or in the mix. So why isn't it that public sources can't simply step up? Well, I think as we all know, national budgets are stretched and the situation has probably deteriorated thanks to COVID and higher interest rate environments globally. In some EMDEs, interest payments can eat up as much as 50% of government revenues. And in Southeast Asia, the proportions are quite high. But even the sort of median emerging market is having to pay 10% of revenues just servicing interest payments. And that's up from about 5% from 15 years ago. So when you add to that the fact that foreign aid budgets are also under pressure, the sort of overwhelming consensus is that public finance can catalyse, but it isn't going to be able to meet the scale on its own. So if you know where the capital needs to come from, the question is, how do we de-risk EMDEs enough to make that happen? And it's no secret that in certain EMDEs, currency and regulatory risk is actually a major barrier to international investors. As are underdeveloped capital markets. But one of the most common themes that we see again and again is a lack of credible data, which limits an investor's ability to judge whether a company is prepared for the transition and physical challenges to come. So for foreign investors, this lack of information creates a higher perceived risk, or at least, I guess, raises the due diligence costs, which discourages participation, even in otherwise quite promising firms or projects. So these risks, perceived or otherwise, are reflected in fairly low international financing for clean energy in EMDEs, which is as low as 27% once you strip China out on average, and lower still in significant markets like India, where I think it's around about 17. So how do we overcome some of the barriers that hold up the flow of capital? Well, of course, there isn't any sort of silver bullet, and I think you've probably heard that enough, that phrase. And I won't want to pretend that transition plans can magically overcome FX risk or some of the other challenges, but they absolutely can start to fill in the data gaps and reduce some of the perceived risk or that fear of the unknown on behalf of investors. So if we can give investors the detailed information needed to more accurately price risk, it allows them to more confidently allocate capital. Now, the problem is, at the moment, the uptake in EMDEs remains quite limited. I've just put some data on here from a very recent Ernst & Young report, which shows that in the UK, which is probably the furthest ahead of the curve, we've got around about 66% of companies disclosing transition plans. This isn't a commentary on their quality, but at least just purely in terms of the numbers. The EU, unsurprisingly, follows second. I think both of these are sort of nudged along by regulatory environments and policy. But the global average is somewhere around about 41%. And as you go down this curve, you see that emerging markets tend to sit at the end. The US isn't actually on here, but that is a bit closer to around about 30%. Yeah, but that is kind of an outlier and due to more political machinations. So we've kind of talked about this, and this is just one final slide before we'll get to our panel. So we've mostly been thinking about this or discussing this from an investor perspective and thinking about how to shift capital cross borders. But increasingly, it's actually competitiveness that's going to drive action amongst corporates and spur them into adopting transition plans, we think. Businesses globally are starting to recognise that there's a strategic value in transition planning. And 56% of business leaders now, over half, see investing in their transition and transition plans as being motivated above all else by their need to stay competitive. I think the done well, a transition plan serves more as a business plan. It helps to identify not only risks and inefficiencies, but opportunities, both internally and externally, so in supply chains, and allows companies to nurture stronger stakeholder relationships. So it isn't just about ticking boxes to try and unlock capital or to keep up. It's a driver of long-term value. And hopefully, I won't go too much more, but hopefully that gives a little context as to what our panelists are going to hopefully discuss with a little more detail and hopefully a little more nuance. I'm just going to stop sharing my screen here, and I'm going to pass it back to, I'll pass it over to our panel now. But just before we get to them, I'd like to introduce them quickly. So joining us today as moderator, we have Namita Vikas, who's a pioneer in sustainable finance and transition planning. As a former senior banker, she led the issuance of India's first green bond. And now she heads up Auctus ESG, where she oversees their work on numerous global projects with governments, UN agencies, and DFIs in emerging markets. I'm also delighted to welcome Jo Paisley. He's president of the GARP Risk Institute, where she leads thought leadership on climate and nature risk for global financial professionals. Jo brings deep regulatory and industry insight shaped by senior roles at the Bank of England, HSBC, and more recently as host of the GARP Climate Risk podcast. So welcome, Jo. Next, we have Madeline Ronquist, a recognised leader in climate and nature risk management. Madeline currently serves as the head of environmental and climate risk at First Rank Group, where she's helped shape global standards through roles with UNEP-FI, ISSB, TNFD, and more. Going forward, she'll continue to drive impact as an independent ESG advisor, and it's great to have you with us, Madeline. Next up, Alvin Jose, representing SE for All. Alvin leads global efforts on energy transition planning and energy efficiency. With nearly 2 decades of experience across Asia, Alvin now supports developing countries to shape investment-ready transition pathways and enabling policy frameworks for clean energy. And finally, joining us from the corporate side, we have Prabhata Acharya, who is the Group Chief Sustainability Officer at JSW Group. He holds nearly 30 years in corporate sustainability and environmental strategy, and brings a wealth of experience aligning industrial operations with long-term climate goals. And without much further ado, I will pass the torch to Namita. The floor is yours.
Thank you very much, Alistair, and special thanks to Shantanu, Sophia, the IEEFA team, the Auctus ESG colleagues for organizing this session. I think it's a very important point, and you've set the context very well to make a segue into the discussions here. And I think across the globes, the governments are introducing regulations that are reshaping business operations, and countries like EU, of course, with CBAM, MAS with carbon regulations and other regulators, India with SEBI. So even the EMDEs have started to action as far as decarbonization is concerned. The signals are very clear. These regulations are targeted at driving transparency, accountability, real progress on a country's climate goals. And this would then require businesses to embed robust emission reporting, reduction planning into their corporate practice. And I want to bring out one more element. I was looking at the percentages that you showed there on the screen. It's literally like you comply or you fall behind, and there are financial implications, hefty financial penalties, legal actions, reputational harm, and operational disruptions that we've seen. But here we are talking about emerging markets, developing economies. We're talking about smaller businesses that need to transition, to do disclosures, committing human and financial resources, which all this includes collecting, analyzing, reporting on several data points, implementing new systems, processes, and employee trainings, legal consulting fees, ongoing management, all of that, right? I mean, just one example here, I was looking up when we were getting into this topic, the EU CSRD, it recommends use of specialized software tools to generate, validate, and tag reports according to the ESEF and the ESRS requirements that are there. So all the reporting standards that are there. And there are estimations by the European Financial Reporting Advisory Group that says that yearly auditing costs for limited assurance, that is companies per 10 million of revenue for large companies, it's almost about 0.013 to 0.026%, or in USD, it could be anywhere between 200 to 260, $70. So these are the kind of costs that we are looking at. And from an investor lens, the cost of inaction is also huge. We saw how BlackRock nearly lost about $90 billion due to their fossil fuel portfolios, right? So all this is, I think, one side of the coin. The other side of the coin are the expected benefits. Such mandates do require long-term strategic investments, but they will build resilience, stakeholder confidence, they will enhance reputation, they will build in the early warnings for identifying and managing those risks that we are looking at. My question is really, all this bargaining power that we are talking about, which we will have with diverse investors, improved access to funding. And I'm going to play the devil's advocate. Is this actually happening in the market? Are we actually getting the greenium that we seek all the time, right? And then that takes me to the existential question of corporations and finance for the corporations and financiers out there, and that is literally to be or not to be. So I want to hear from the panelists, which is a very diverse group, as to what kind of balance we need to really assume, and where is the what is it that we look at when we go ahead with how transition plans are today becoming essential tools for identifying climate related risks, attract long term capital, but is that really making the impact? So let's go explore this. I will go to Joe with my first question. Joe, uh, we're talking a lot about transition planning. So what makes transition planning essential for organizations in the current climate and regulatory landscape? And how should policymakers respond, especially in the light of the recent omnibus legislative changes in the EU that may signal a scaling back of climate ambition? I mean, that's what people are talking in the market. So over to you for your response to.
Yeah, no, thanks very much. And for those of you who don't know GARP, we're a global or sort of membership organization focused very much on risk education. So transition planning, I think about there's two different angles. There's kind of what you do internally and then what you disclose. And ideally they're similar, but they might not be exactly the same. It depends. There's some commercially sensitive stuff you might want to not want to disclose. But, internally from a risk perspective, and you would expect me to come from a risk perspective, it would be madness not to be thinking about the transition, given just the context which Alistair set out so clearly. But you think about what's going on with the climate and, the inevitability of the transition. It's not like we have a choice. The physics determines the fact that we have to get to net zero at some point. Otherwise, the temperature just keeps rising. And that's not so good for human beings. So we know the destination. Unfortunately, we don't know how fast or when we're going to get there. That makes it incredibly challenging for companies in this environment, because when you think about the elements of transition risk, you don't really know when they're going to bite. So, companies, just take a classic company with a complex supply chain. I was talking to a professor of supply chain management on our podcast, shameless plug there for the GARP Climate Risk podcast. But he told me that, on average, it would take about 10 years to understand your full supply chain and decarbonize, because it's not just your immediate suppliers, it's also, the second and third order. And we know that for most companies, their scope 3 emissions are a very big chunk of their emissions, and the risks are going to be in the supply chain, let alone the physical risks. So if you don't start now, or if you haven't started now, you're already a bit late because you don't know when policy will bite. And if you think about the elements of transition risk, you've got policy, which is kind of one of the biggest ones. You don't know what's going to happen to carbon pricing. And I suspect that as the physical reality of the world we're living in and going into becomes ever more apparent, there will be more calls for more stringent policy, I would hope. So you need to kind of get your house in order, and that's all part of transition planning, in my view. It's not just the disclosures come after you've done all of this stuff, to be honest. The elements, I think about, you've got consumer sentiment, which can switch overnight. If you're not taking this seriously, you just don't know. And with the speed of the media and social media, and this is a very difficult environment for companies if they're not really on it. From a technology perspective, of course, I mean, technology, things like AI are changing at a phenomenal rate at the moment, and that brings transparency. It also brings massive opportunities for companies as well. And if they use that technology, they can speed up some of these processes, and that brings us to, the technological advantages that companies have in emerging markets. They can arguably leapfrog the old dirty fossil fuel technologies. And then they can avoid the problem of stranded assets, and they have all the other kind of co-benefits as well, like cleaner air quality and, all of those things that we like about clean energy and clean technology. So I think, just thinking about the environment, transition planning is absolutely critical. Disclosing it is absolutely critical. As Alistair said, if you're looking for investment, you need to tell your story. And I know, Namita, you were talking about what makes a credible transition plan when we've discussed it. Well, there are frameworks out there, and the TPT framework in the UK was set up, and that's now actually been taken on by ISSB. It was actually set up really as an international framework. That if you just follow one of those frameworks, not only is it good for your disclosures, it's also good for you to organize yourself and think about all the different elements you need to think about when you're doing a transition plan. And the credibility will hinge on the details, on the specifics, on your plans for CapEx. Does the financials actually back the ambition you've got? And the final thing I would say is sometimes these things, it's not just about the commercials, though they are highly important. There's also a cultural aspect to this as well. If the whole company is, the transition plan really needs to be the business plan, the strategic plan. This is the journey you're going on. It's not something that just the disclosures people do. This is the plan. And you can bring your company on that journey, which helps enormously with kind of cultural internal alignment. So huge advantages, I think, culturally to doing transition planning well, and commercial advantages to disclosing it to the market. I don't know if that's kind of enough or too much.
No. Great. Thanks for those. Thanks for those comments. I think a story without a credible transition plan is not adequate for investors anymore. I agree with you fully. And I picked up a point that you mentioned on the risks in the sitting within the complex supply chains and in unavailability of forecasts. And if you look at financial institutions, I mean, within banking, the carbon emissions, so the financed emissions are 700 times higher than a bank's own emissions, right? I mean, that's what the data says. And that makes a good segue into the question that I'm going to ask Madeline. Madeline, consistent and credible data is absolutely fundamental for effective risk pricing. And, we talk about this all the time. However, in many emerging markets, disclosure frameworks, taxonomies, transition planning, all these in terminology as well as in terms of the concepts are still maturing. So what advancements are you observing in the quality and the availability of transition related data in these regions? And additionally, also throw some light on how does the lack of complete or consistent disclosures impact your confidence when you're assessing the corporate risk for projects within these markets? Over to you, Madeleine.
Absolutely, yes. And Amita, you mentioned balance, and that just made me think that just to give you the context of the South African market and sub-Saharan Africa, is that we have very large multinational companies who are listed, and they have been reporting in the CDP or in their integrated reports on their carbon emissions for a very long time. So we find that when we engage with our clients in the wholesale and investment banking market, we get access to accurate data that has been externally assured. And what we usually ask for is a firm transition plan. Even if it is a hard-to-abate sector, we will still finance and engage because we prefer to stay engaged with clients to help them transition. But we want to see where they are going. And so for that market, it's actually quite easy to get absolutely accurate data. It gives us the ability to set interim targets and long-term targets and to manage that throughout the process. For the unlisted market, though, which we also have, it's not that easy. So there we don't have data. And I think one of the primary reasons is that the Climate Change Act was promulgated this year in South Africa. And under that, we will need sector emission targets. Now, we've seen a draft paper and then it's gone quiet. But I think for us to set transition plans up according to sector standards and sector emission targets, we need that regulation. What we are doing in the interim is we are using sector averages and using the PCAF methodology to determine an estimated financed emissions in the unlisted community. So we are working on that because absolutely you're right. We want to eventually be able to integrate these KPIs into our risk pricing models. And although we do very well on the sustainable finance side and we can easily positively price sustainable finance products, we are not yet at the point where we can negatively price. Yeah. And so we need more data, we need more accurate data. And we are starting to build a database. We are creating a platform where you can actually attach a climate rating to your unlisted client so that you get some direction in there. And we are engaging with our clients in the unlisted market, but it's really a consumer education process because it's not regulated for them to measure their emissions or to transition or have a target. It will take us some time to get to that point. So coming back to your question, it does question your confidence in the numbers that you're putting out there. And we can collect data on where we finance solar as a solution, and we split the categories into where we avoid emissions. And so we are starting to get that data together, but you are right, it's a maturing process and we still have a way to go.
Great. No, thanks for that, Madeleine. I think, I agree fully that it's a little easier to positively price, your risk, but not so much from a negative risk standpoint. And, consumer education becomes like a big task because all said and done, it's not in many markets, it's in many emerging markets. It's not that you can say no to a project just on the basis of this. You can say no on the basis of financial data, or not on these aspects. At least I don't think we've matured to that level. And you mentioned about sectoral emission targets and sectoral related frameworks data, and I think that's a very important question for Alvin. So Alvin, I'm turning to you for this sectoral perspective, and it would be really nice for you to elaborate on SE for All's engagement, particularly with state-owned enterprises on their energy transition journeys. And I'm very curious because you've recently, SE4All has, inked a partnership with NTPC in India, and they have announced their energy transition planning. So could you share the imperatives, the overarching, share more about how you're going about it? I'm very curious to know what NTPC is going to do. So over to you.
Thanks for your question, Amita, and thanks again to Active CSG and IFA for inviting SE4All and me to this session. And also, just for everyone, those who don't know about SE4All, we are a UN agency that primarily was born to champion SDG 7 achievement and make sure that all of us are, while doing that, achieve our Paris goals at the same time. So maybe just to begin with, I guess, one of the key things that we realized while engaging with primarily developing countries and emerging markets on various issues across, deployment of sustainable energy solutions is that, in a lot of these markets, state-owned enterprises really play a key role in the national energy transition plan itself. So typically when we are engaging with the governments to have the government's view of their national plans, a lot of this really hinges on how the state-owned enterprises really operate as well. I mean, just a few numbers, for example, is like, in EMDEs, around 70% of the power generation is from SOEs. And, look at the emissions, it's around 55%. And if all of them kind of really unlock towards clean energy investments, you're looking at around $500 billion of investment by 2030. What that means is essentially is because that SOEs could be critical enablers, but at the same time they could be blockers of the transition journey as well, right? But I would like to see this more of like an opportunity and that's why because a lot of the questions, the technological questions that needs to be answered in a lot of these countries may have to be at the testbed of these SOEs and their scale up, to be honest. So their participation and their leadership is super important for us. And that is why we started this SOE engagement, mostly in EMDEs. We have been primarily started with more of at an advocacy level when we started this journey 5 years ago, where we have an initiative called the UN Energy Compact. One of the main aspects of that is that we have engaged NTPC, Denmark's Ørsted, Indonesia's PLN, and Pertamina for developing their energy compacts. And in these energy compacts, they identify their clean energy ambitions. So, and then they disclose this through a compact signing and showcase exercise. And we typically have, showcasing events during the UN General Assembly and New York Climate Week. So I think one of the main things for us is to make sure that SOEs, recognizing that SOEs have a big challenge on their hands, right? They have traditional business models that they have been used to. They are trying to, interact with the changing market dynamics that may not be only driven by climate targets. There are other issues that they're changing for as well. And then on top of that, there are these, very dynamic discussions happening on climate targets as well. And since then, we have been working with a lot of the developing countries to develop their national energy transition plans, very specifically because countries are now interested really to understand that the energy transition movement is on its way, right? It's not going to stop. In a lot of countries where even if the regulatory framework is not there, market economics is really taking over and showing the road. There's a lot of now the world is actually basically hinging on whether 2050 net zero happens or not, right? There's a lot of anxiety around it. The bigger anxiety for a lot of these countries is that will they get access to climate finance or not? Till now it has been very underwhelming, to say the least. So while they're trying to do this, they would like to understand, okay, what is the kind of time horizon that they have got to do their orderly transitions? What's the kind of technology pathway that they have when they want to use this targets? And then really what kind of investments they're going to be looking at? What is the kind of lift that they themselves have to do out of their books versus, crowding in global private sector investments? And a natural kind of step to that was while discussing with these governments, we had some interest from SOEs to kind of help to think them through, because at some level we also think from a very much a development energy kind of climate nexus when trying to solve these kind of questions. Coming to the NTPC partnerships itself, it is a more recent announcement, and we are very enthusiastic and excited for this piece of work. It's a very strategic partnership that we think will help India to achieve its clean energy and climate ambitions. We have actually previously also worked a lot with the government of India to work with their G20 presidency on the doubling energy efficiency target, which was featured in the G20 declarations. And this is just a natural step, we feel, after that. Very specifically, I think on the NTPC side of things, I think I'll try to focus on what are the key imperatives that they have in front of them, as I see it as of now, and maybe some of the areas that SE4All's partnership with NTPC will try to address them. One is that NTPC is no different from any other SOE in India. In fact, they are trying to react to a changing world technology paradigm. And at the same time, there is a very, 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 aggressive targets that the government of India themselves have set up to do, right? So there is a need for alignment for that to happen. Some of the key steps that they have themselves set up themselves for is a 60 gigawatt renewable energy share by 2035. They have a multitude of technology options such as nuclear, along with renewable energy, and improving their own energy consumption in their current plants, as they have set up some targets around that in the near term 2035. Beyond 2035, there is a key aspect that they would need to also think about, is that the government of India has announced the Viksit Bharat 2047 target, which is a target for India to become a developed economy by 2047. Now, that is going to require huge amounts of electricity. I mean, electricity is one part of it, but energy in general, right? So the other SOEs would also be thinking about how to kind of really supply it, while their competitors around the world are electrifying their sectors, going into newer technologies, selling essentially to their consumer cheaper products at the end of the day. And the consumer dynamics is also really changing, right? A lot of the consumers are also asking for these, low emission products as well from their side as well. That is one big piece that they need to think about. The next biggest piece that they need to think about is the 2070 net zero goal of India. Now, while we expect sometime this year for the government of India to announce what does that look like, that pathway look like, and this has been in the works from what I've been reading on newspapers at least, is that the technology pathways essentially would need to, then NTPC would need to make sure that whatever they're going to aligning it has to be at least in preparation of that, right? You cannot expect exactly all the transition to happen at the same timeline. So as early movers, they will have to think about how they kind of really capture the market. So I would say these are the kind of clear imperatives in front of them.
Yeah.
In
That's
terms
good.
of,
Yeah.
finally, just a couple of points. In terms of the intervention that we want to focus on would be how to ensure that energy transition planning becomes a part of the long-term corporate planning DNA of the company. And that's something that we are trying to kind of think about and test out right now. Thank you very much.
Yeah, I think that's a very good point in terms of how to make the whole transition planning be a part of the corporate planning, and that's where it becomes a part of the strategy of the business areas that one looks at. And it's a very good initiative with at the SOEs, because I believe that that's a huge area where change can be undertaken, and with speed, because if the government is supporting something, then that can go to. But I'm picking up on the corporate angle that you mentioned, and I'm going to go to Prabodha. So Prabodha, I JSW has emerged as a regional leader in decarbonization of the steel sector. It's one of the most challenging industries to abate as steel. What were the main drivers behind JSW's early and ambitious transition efforts, especially given that the absence of a level playing field, right, both in India or in international markets for green steel? I mean, you started on pretty early. So, what were, actually highlight some of the internal, external factors that really motivated JSW to invest heavily in the renewable energy, hydrogen-based steel making, innovative sustainability initiatives. I mean, all this despite facing cost and supply chain challenges, limited regulatory incentives. And somewhere I want you to talk about that culture that Joe brought out earlier. So over to you, Prabodha.
Namita, thank you very much for having me. And just for the benefit of the audience, that JSW being the largest steel maker in India, but we have interest in energy, cement, paints, and so many manufacturing facilities. So we are purely in the manufacturing sector, and our objective is to support the growth of the nation. When we talk about the growth of the nation, we need to look at the holistic growth, and I think somebody talked about we need to leapfrog. But when it comes to transition planning and why we adopted, to answer your question, I think it will be prudent to tell what our transition plan is. We have set targets to reduce
Sorry,
our
Prabodha, we lost you for like 5 seconds. If you could just.
Oh, okay. Now I'm back. Okay.
Yes, yes.
So I was telling, before I tell why we adopted a transition planning and are working aggressively, I think it's prudent to tell what our transition plan is. And that is where we have set ourselves a target to reduce 42% of our emission intensity by 2030 with a base year of 2005 and achieve net zero by 2050, which is 20 years ahead of commitment by India. So naturally, the question comes, what Namita, you asked me, why we are so aggressively doing that. And to answer that, I think Alistair showed the first slide as a climate risk is financial risk. But what we believe in our company, climate opportunity is financial opportunity. So we focus, if you look at our transition plan, by the way, we made it publicly disclosed through a climate action report, because we believe when you make a disclosure, you remain committed, and then you need to demonstrate the progress. All the levers that we have identified to decarbonize ourselves by 2030, these are business opportunity. In fact, when we committed that we'll be investing around $1.2 billion to achieve our target, we never stated that we are going to spend. We always tell that we are going to invest that amount. That means it is going to give return. If I bring examples like, we all know renewable energy transition is an investment and which gives return. Early you do, you get a business benefit. Okay, efficiency improvement. And that is where I think Joe talked about cultural change and how transition planning brings in cultural changes. I'll take one example that we are doing. From 2023, we launched a program which is named as SEED, that is Sustainable Energy, Environment and Decarbonization Program. It is all about changing the mindset of the people in all hierarchy of the organizations and motivate towards to produce more with less. When you motivate towards produce more with less, what does it mean? You are encouraging to improve your efficiency. And that efficiency improvement gives you also reduction in your emission intensity. So you get a double benefit. And just to identify what we anticipate, this program is going to reduce almost 18 million ton of CO2 emission by 2030. Just imagine, this is almost equal to taking out 3.5 million IC engines car from the road, or equivalent to annual emission of a country like Sri Lanka. That's the benefit we are going to get. But most importantly, business is going to business benefit in financial term, because you are improving your efficiency, thereby you are reducing cost for the product what you are producing. So this is one of the example how the cultural change is driving to make your transition plan successful. Okay, but there are other drivers. When we early on put this program, we know that regulatory, because we have seen the stakeholder expectations are increasing, specifically in hard to abate sector like steel. uh, Investors expectations were increasing, because in the mid of 2022 we were talking to raise finances for expansion of our project, and that is where we find that when, by the way, we became the first steel company in the world to issue a sustainability linked bond to raise capital. And that is where we found appetite of the investors to commit to reduce your emissions, and thereby they are willing to put money. So, in a sense, what I want to say, climate mitigation is good for your business from all the angles. All your stakeholders are interested. Nowadays, even if you see, besides the investor who are having very clear expectations to reduce and decouple your growth from the, from your emissions, the regulators are getting interested. Now, Namita, you would have been knowing in India specifically, steel sector is trying to reduce their emissions to a particular level of 2.2 by 2030. So, and when we put our level, that means we are ahead of curve already with respect to the regulatory pressure which is about to come. So, anticipating what is going to come and being prepared is also an opportunity. We also see the customers acceptance, and you meet their expectations before they come to you. Some of the sector where we could see, like, as energy transition is happening and India is taking a lead towards energy transition, you can't have an energy transition without having steel. And we see the sale of our steel in the RE sector is tremendously growing, and people have started demanding also low embedded carbon steel to support that. So if you have taken your transition plan in advance, you are ahead of the curve, so you get a market, and we could see that market growing. Similarly, on the electrical steel portion, when efficiency is improving, I think Albin, he talked about how the energy need of the India is going to be tremendous. So if you have to, that's a fact, because energy is prosperity and everybody will like to have more energy consumption. So that is where electrical steel will provide that efficiency improvement, and we could see the demand coming. Besides on the high strength steel, which is being demanded by, electrical mobility or in the mobility sector. So there again, if you have a transition plan, low emission plan in advance, so you get advantage, business advantage. Although I am not discounting what Alistair started with, that climate risk is a real risk to the business. In fact, our board level risk committee reviews the climate risk, but to drive the point across the organizations, I would prefer to highlight the opportunity, because business loves opportunity. So we need to show climate change is the opportunity. This is what I wanted to say, Namita. And by the way, on the early of this month, Carbon Transition Analytics published a report on JSW Steel's transition plan, and I was very happy to see that they have confirmed that our transition plan is credible and growth strategy is responsible. Of course, they have given a lot of input for us how we can improve that. We welcome that, but I think this third-party assessment and critiques uh, helps us to stay on course. So to opt for your agenda today, de-risking through disclosure, I think this is very important to disclose. Therefore, you provide your commitment. Therefore, you are subject to those analysis by every stakeholder, and you course correct and become more efficient. So with that, let me stop here, Namita.
Yeah, no, Prabhuda, congratulations on that. And I think, you indeed have, showcased how there is a first mover's advantage from a business standpoint, and how you've challenged the normal in terms of moving fast forward. And what I relate to very well is, because we did that in banking, you turned the whole problem on its head by looking at the opportunity side. So I have done that in banking. Doing the green bond or doing first to market products was more from a business standpoint rather than to cover the risk. I mean, you would anyway cover the risk, but that's really very apt that you've said as to how the culture needs to be built, how it needs to be looked at the same time. How do you have institutional framework and strategies that will back up that culture? So thanks for that. I'm just coming back to you because I'm now moving. So we were here talking about the first section that earlier was mentioned, which was role of transition plans in risk management and capital allocation. And now we will go to the other theme where we are looking at the strategic value and the overcoming aspects of the barriers in implementation, essentially. So, Prabodha, I want to go to you, and because there would be barriers, and there's so much spoken about supply chains, right? So, how has transition planning at JSW helped uncover the hidden risks and reveal new strategic opportunities? So, while you mentioned about board committees overseeing the risk aspects, how did that process work, and maybe highlight a little more about supply chain resilience, operational efficiency, talent retention, or other areas that it impacted. So over to you.
No, thank you, Namit. I think if you talk about the barrier, the single most barrier is the mindset change. Everywhere, if you want to do something, it is the mindset change is required for the people. And specifically in business, if you look at in my last 30 years, I have seen the only thing, if you highlight, as I stated, the opportunity and benefit, the mindset shift happens. The examples that I gave in the transition planning, how is that helped? Before I address your specific questions, it also gives you a cost leadership, because our objective always has been how we can produce the product with low cost, at the same time decarbonize ourselves. So that has been our mantra. I mean, that is what we work towards. So it uncovers your cost leadership and you identify those opportunity, whether it is optimization of your supply chain, ensuring your supply chain is always available and you de-risk those by different sources, or by educating your supply chain to be aligned with your transition plan. For example, we launched a supply chain partnership program where we have now covered almost more than 60% by business value, all those our suppliers to onboarded with us and agree to align their business plan with our transition plan. So this is something we are working, educating with them. But the other thing, as I stated, efficiency improvement is very important, which gives you the benefit and new business opportunity. The other thing, when we started planning our transition, there is no hints that Europe will come with CBAM or UK will come with CBAM. So we never, I mean, in 22, I don't think it was being discussed, but we never thought it is, the carbon is going to become one of the essential elements of trade, right? And therefore, it will have impact wherever you operate, not necessarily you are operating in Europe. So when we started our transition planning, I think we were better prepared now to deal with the regulatory risk, which could be upcoming regulatory risk, right? Although our products are mostly produced to Indian market, but 3 to 4% we also export to there, and that's takes our business advantage, because we get a lot of benefit out of that, and extra production what we make, we get a market. Now I think we are better prepared for the upcoming regulatory changes. Um, Interesting point, Namita. You prompted me to talk about the talent retention. My interactions with all the young generations when we are hiring, they are not asking, because see, in India at least, JSW is very well known as a reputed organization. People want to work with us. But interestingly, I am finding more and more younger generations, people who are coming from the Bright Institute, they are asking, can we work with sustainability first? So, and when they're going to our factories and they're seeing these changes, like in factory, if you visit any of our factory, we have created something called Climate Action Center, where all the functions come together and discuss, debate, and find right mechanism, methodology, technical changes, process changes to become more efficient and more carbon efficient. And that is where it motivates those people, specifically younger generation. I've seen they get motivated to work in the organizations like the JSW, for the forward thinking organization. So there is a benefit, the goodwill that you get in the market, uh, whether it is customer, whether it is investor, whether it is regulator, that credibility is established. So yes, transition planning has helped. It is going to help. And my advice, I think Alistair showed the chart to us. Indian companies still less than 30% disclosing their transition plan. I'll see that all the companies disclose their transition plan, because disclosing is something is akin to commitment, because you have discussed and now you are ready to go to public. So that is where Namita, I will stop.
No, I think this is very good, Prabodha. I think we all preempt risks, but taking credible action and that resulting into the ability to be able to navigate the risk that then came in the future. I think when you mentioned about CBAM, I think that was I know that working with some of the clients in the Indian market in through 2020, 21, nobody believed that CBAM is going to be a real risk, right? I mean, it was not even spoken about. But I think knowingly or unknowingly getting into it has only helped JSW. And there are many leading corporates who have done work that JSW's maybe representative of. And I would go to Alvin now to ask about, when private corporations have taken this lead in setting ambitions, setting targets, implementing concrete actions. How do you see the opportunities now emerging within the SOEs and nationally significant organizations? Because and you did mention about how NTPC is looking at their own pathway, but aligning to the global transition planning frameworks, enhancing their disclosure practices. How do you see some of the bottlenecks at subnational level, maybe? So if you could speak a little bit about that and your experience, please.
I think in terms of transition planning opportunities and how we can really get the SOEs to kind of follow the private sector suit is sometimes a bit of an unfair comparison, in my opinion. It's just because they are just different natures and different kind of, let's say, drivers that really kind of let them kind of, choose the path that they do. But at least what I have seen certainly is that if a sovereign has taken a decision to do its transition planning or its net zero goals, we typically would see a suite of other SOEs kind of following closely behind it, because that's the nature of SOEs in general. So I think one of the key things that we need to do if folks are interested in a particular market or a region is to first maybe not ask why the SOEs don't have a TPT. I think the real question is, why doesn't the government have a TPT? And I think a lot of the questions will start kind of falling into place after that, the answers that you need. So that is the first thing. Second is, I think when it comes to, let's say, in terms of like real opportunities, I think one of the key opportunities really is that unlocking climate finance in these economies has been a big challenge. And these SOEs like really provide that opportunity to kind of like really bring in, because they have reasonably good books. They can come in with a lot of sovereign backing for kind of very nascent technology testing, and really a lot of the scale up that is required for really these technologies to kind of really flourish. And in fact, you could see its experience even in like countries like India, China, and others, where the state really played a big role in really driving your utility solar PV costs by even 90%, right? Like the state really played a key role. So I think they really would be an important alignment there. And so focusing on specific technology, let's say like wins could be one way of aligning things. I think more specifically, one of the biggest challenges that I would see that the SOEs can really unlock in a lot of these countries is that I don't see renewable energy capacity coming in these countries as a big challenge. Capacity is not the problem, evacuation is the problem. And a lot of the SOEs like really, hold a length and breadth of the nation's grid. And maybe kind of, working with them to kind of how can, these coming in capacities can be well evacuated with these grids. They could play a very key role. So integration of renewables, variable renewables, especially into the grid, they can play a very key role. And you could see that, especially as in South Africa with ESCOM's example under the JETP framework, they were really focusing on how to make sure that the grids are really resilient and they can take these new renewables into the system. So, and that kind of helps move. Only once these things starts working can there be a confidence. Okay, I'll put targets, I'll create more ambition, etc. So I think that's the main reason. I think the key barriers for me is number one. I think somebody said it away, but I would like to repeat it. Is a bit of a short-termism, right? They unlike any other firm or entity, the leadership is pretty much driven by short-term targets. Typically aligning with a lot of political cycles in these countries, right? So I think that's one of the key barriers, and I think one of the ways to counter it would be to say is that well, our short term is now 2035, right? If in this short term these actions are not needed, we will not be able to reach 2050, let alone 2060 goals, right? So I think that's where you make actually the call for action or call for doing these things as a very important short term action points. Second, I think would be is around just general institutional capacity, because one has to really understand that SOEs, the way they plan their companies around is very different from how the private sector would plan, right? So I'm sure that a lot of these companies have their sustainability wing, but how do you really make sure that they have the capacity to kind of sustain a long-term strategy? Make sure that these strategies withhold kind of leadership changes, and like it kind of runs in their DNA to kind of do this. And what kind of tools do they have to kind of rely on? What kind of networks do they have to kind of rely on? What kind of good advisors do they really have around them? I think the key thing for any planning person is that they need to feel safe before making anything on the paper, right? So I think that needs to be kind of really worked on, in my opinion. And I think once these two key things are set in, I think we can make a lot of progress.
Great. That's a good way to look at it, and that brings me to Madeline. When we are seeing SOEs, transitioning and making plans, and that now all this information percolating down to the smaller SOEs, and they looking at how do they transit. I think the whole aspect that one should not ignore is social equity and labor considerations, which are very central to achieving a just transition. You mentioned about how you are working with your borrowers, which are essentially corporations in the region, to translate global standards into practical yet socially responsible plans, right? So could you share some examples from your experience where you have helped, or other financial institutions have helped companies integrate the social dialogue, the skill development, the stakeholder engagement into their transition strategies to ensure that both, so not just climate, but also social objectives are met? Because we do not want to have a transition where we ignore the community that is going to get impacted, right? So over to you, Madeline.
Right. So I just wanted to give the background. So South Africa has had very good programs in terms of the government taking the lead on REAP, as I think Alvin mentioned. But then they went a little bit quiet on their decarbonization of the grid. And so what makes this interesting is, Namita, I've been in the banking environment for most of my life, and where in my younger days, I would say to the advisors in the bank, they have to assist SMEs with making decisions in their business. They didn't want to do that because they said there is legal liability attached to it. But I've seen that model change to one of an advisory capacity and really engaging with clients. And we do this through our app that we use. There's some tabs that is called Navigate Earth, Navigate Renewable Energy, and we even give them suppliers that do renewable energy. Of course, what has driven this opportunity quite tremendously is the fact that South Africa has a huge unstable energy grid. And for that reason, we went through a period of long-term outages. And so we saw an uptake in the market of renewable energy solutions. But with that came the opportunity for us to engage, to raise consumer education, to make opportunities available. The other way that we have worked is through industry engagement, because there you reach other corporates as well. And also engaging with SMEs at the levels of, so something that has facilitated this very nicely is that we get development funding from banks like the World Bank. And these days they are earmarked for climate solutions. And the target audience is SMEs, but particularly women in business and youth. So that has almost forced us to use that financial capital flow towards those outcomes and for us to engage and use the opportunity to advise and to educate. Through our industry engagement as well, we have developed transition plans for sectors based on the just transition. So that was the golden thread that went through the entire development of those abatement plans. And those are the ones that we suggest for all industries, whether they are large corporates that are listed or whether they are start-up businesses that are starting out small, because there are some low-hanging fruit that they can implement that makes their business more efficient. And of course, we are including the bigger scope of not just talking about energy, but also talking about nature and biodiversity opportunities, and teaching companies how to be more efficient, and obviously then in the long term being more competitive.
Yeah. No, that's really makes me think about how I think the bottom of the pyramid concept is made very famous by Professor C.K. Prahlad, and who really opened up the opportunities for even banks to look at social and inclusive banking. And I'm glad that there are so many TAs out there now, technical assistance programs out there now, which focus on these areas. I think there's a good way for financial institutions to also look at educating more and more of the customers to look at a just transition. So thanks for sharing that, Madeline. I would go to Joe now. And Joe, we've been hearing about a lot of proliferation of diverse taxonomies and standards that risk and make this whole space more complex, especially for emerging markets, especially for SMEs within these emerging markets who are at a disadvantage. So tell us, how important is it, according to you, to have harmonized taxonomy standards and frameworks that will bring in consistency, accessibility, and ease of navigation for the firms from a transition standpoint, and especially the MSME sector? So if you could just throw some light on it, please.
Yeah. I suspect if you asked any business person or anybody working in a company which needs to report, would you like harmonized standards or do you care? They'd all say, I'll have harmonized standards, because it just makes so much sense. I worked at HSBC for a couple of years as their global head of stress testing, and I had to deal, having been a regulator, I then had to deal with all the regulators, and I saw the pain of having to do all those stress tests with different templates, and nothing was harmonized. So that experience kind of scarred me a little bit, and I think probably people working in commerce shudder at the range of different standards. so I think it just makes sense. And you're never going to get one standard. It's not going to fit every market, but you want standards that kind of are interoperable so that you can, you know, if you meet this standard, it's good enough and it maps reasonably to this other standard. It just makes a lot of sense. I mean, just stepping back a bit, you know, you talked about in the EU with the omnibus regulation there. I mean, the EU kind of went further and was more ambitious than other regions. And now, of course, there's been pushback. And I think the pushback, you know, I hope it doesn't go too far, but I think it's a natural reaction when reporting frameworks become very onerous. You know, I've heard a lot of firms talk to me about their sustainability teams. All they do is reporting. That cannot be sensible. You know, reporting is not the purpose of all of this. The purpose of this is to combat climate change and decarbonize our economies. So if the reporting isn't helping with that, it's getting in the way of it, then you need to rethink and you need to be super pragmatic. I know I talked to somebody about the EU taxonomy because I must admit I was a bit confused about it all. And she was there at the beginning of it. And the EU taxonomy, you know, she likened it to a dictionary, really. So think about, you know, you've got organic apples and non-organic apples. The dictionary tells you what the definition is of organic. And if you don't meet those standards, you can't call your apples organic. That is a very sensible thing to have. But what's not sensible is then for everybody to think, well, I got to prove that my apples are organic, even if they're not. It doesn't mean we can't eat non-organic apples. But eventually, all of our apples need to go towards the green, you know, that meet the standards, but they're just going to go at different times. So I think sometimes people have misunderstood the purpose of taxonomies. They thought they've got to cram all of their activities in it. They're not kind of being sensible and realizing actually this is a transition. So I think, you know, we need the taxonomies. We need as much alignment as possible, and we've got to be super pragmatic, frankly, about when reporting helps or hinders the transition, which is actually what it's all about. And the final point I'd make is I sometimes feel that people think that reporting is what is going to drive this transition, and it's not. It's the fundamental kind of economics, it's the markets, it's the policies. That's what's driving the transition. That is the most effective way to drive the transition. So you get real world decarbonisation. And then the reporting should follow. The reporting is not driving, it shouldn't be driving anything. So I don't know if that's controversial, but that would be my view.
Yeah, but I think, I mean, reporting may be a good start to understand, and it's like a good scorecard, I would think, to look at, you know, where you are today and where you want to go. But it can't be the, you know, it is a means to the end, essentially, and not the end in itself. I agree with you. Great. With that, I mean, I had two questions per panelist. So I've come to the end of those questions, but I do see in the question box some questions. So there are a couple of questions for Prabodha, and these are related to JSW. So Prabodha, the one question is, and you can answer both together. One question is, considering JSW Steel efforts to improve efficiency in products like electrical steel and reduce embedded carbon, how do you see the role of transition finance? So maybe in supporting such innovation. So maybe you could speak about the sustainability linked loans, the bond that you did, and you know, throw a little more light on it, especially because you know there is so much scrutiny around financing hard to abate sectors. I don't know the scrutiny around financing hard to abate sectors, but yeah, maybe you could talk about the positive part. And the other question is that uh, how should firms in hard to abate sector like steel navigate the challenge of raising credible transition finance, especially given the risk perception and negative connotations associated with high emission industries?
Yeah, Namita, thank you. I think both the questions are related. But before I answer the question, I think Joe made a very significant point. I tend to 100% agree with her. Reporting should not be an objective. At least as a chief sustainability officer, I realize that doing things and getting the buy-ins from all the stakeholder to move the needle should be our main objective, not to report. Report is just an outcome, and obviously you have to report because that will record or that will provide a commitment. I think, Joe, that is a fantastic point. I really agree. Coming to answer the questions, I think both uh, transition financing is very much essential, and this is more needed in the hard to abate sector than what you see all this green financing or sustainability financing going towards the renewable sector. I mean, I think renewable sector had enough of their pie. More of the finances need to come to hard to abate sector transition financing, and specifically the growing economies, the emerging economies where these sectors are going to grow. As Alistair has shown in the graph, if you see in India, the transition financing is coming very less. I think 15 to 17%. He showed. I wish that need to be in the reverse way. That a lot of money is needed. Yes, there are scrutiny. The scrutiny because we also need to realize that you cannot have a binary standard for the whole world when you talk about transition. The transition cannot be the same for every region. We need to recognize that fact. The transition has to look different for different regions, and basically they should be futuristic. They should be what you call conservative, and they should be optimist. So so that is what my point is. I have seen when we raise first time the sustainability linked bond, the investor from a particular region expected the transition in my region and my industry should be exactly look like the country in which he or she is sitting. So that's not possible. That's not going to happen. But later they got convinced, because you need to be ambitious. You have to put those ambitiousness. So therefore, I think recently you might be knowing that we put forth from IFCA a transition financing guideline. Similarly, this guideline has to be formulated, and that to be flexible, and that will attract more and more transition financing. The other experience what I have seen, we as a large corporate, I don't have a problem in accessing finances because my credit worthiness is very good. So I don't have any problem in financing. Question is, do I label it as a transition financing, sustainability financing, or I take normal financing? And that is where the internal struggle happen between chief sustainability officer and chief finance officer. So chief finance officer's argument, what's the benefit? The cost of financing is also not significant to take that kind of risk. But again, that actually, I say that differentiate from the leader and the follower. So if you have to leader, you have to set example. You need to take those risks, and you need to early mover. But at the answer the question, yes, it is very much essential. We need a lot of transition financing to move the needle forward. Decarbonizing hard to abate sector are not too easy. In fact, I don't like the word hard to abate sector. Namita, my view is that when you tell hard, you mentally switch up. Oh, it is difficult, I'll do it later. As a society, we must re-christen this as a priority to abate. We all need to
Absolutely.
work towards to address this problem heads on now, rather than telling hard, I'll address in the later. That is my personal take, and I keep on telling, don't call it hard to abate.
No, I fully
Yes.
agree. I
Yes,
fully agree. Yes,
we need to move the needle faster.
yes. No, I fully agree with you. I think I should also correct it. It should be priority to abate and not hard to abate. Yeah, I know how.
Yeah, I keep on advocating everywhere. So thanks that you are already converted to that.
But it is not tagged as transition. So within banks also, there are no mechanisms to asset tag to be able to see if their asset is actually going to transition. It's more of balance sheet borrowing, well taken. There's one more point, one more question here that I want to throw up to all the panelists, anybody who wants to answer. And this is about, what the question is, what are some of the hidden costs or overlooked risks related to FX exposure that clients face during portfolio transition involving international assets, and what best practices can help manage this effectively within the transition planning network. So basically, foreign exchange exposure and risks that is the question revolving around. So I don't know, Madeline or Joe or Alvin, Prabodha, anybody. I mean, it's a open question.
Namita, I think the best example that I can use at the moment here is CBAM. So we come from a carbon-intensive economy, and we now have the UK CBAM and the EU CBAM, and we export to both those companies quite considerably. So this is something that is a real point of discussion. But I think what we are doing as the bank is we're turning the conversation around and saying the more competitive you are, the lower carbon you emit, the faster you transition, the more access you will have to trade in Europe and the UK. And that must be seen as an opportunity. And that's turning the risk on its head.
Yeah. Okay, anybody else wants to add anything to that? Okay, so
Amita, I don't
that's
think
right.
I'd be able to do justice to answer this question, but I think the forex exposure usually handled through hedging, but that's something my CFO can confirm.
Yeah, no, that's fine. And then there's one more question here. For domain to thrive with speed and scale, the climate finance and reporting entrepreneurship ecosystem holds the key, as there are flag barriers of climate action with timely finance in the climate projects. As the reporting and standard setting organizations either operate as not for profits or as affiliates of not for profits, what are the business models and collaborative options for AI tech entrepreneurs in the climate finance domain? Oh, very interesting. So, Alvin or so.
No, one thing I
Anybody?
can tell Namita here is, the technology, whether it is AI or digitization, plays a very important role in decarbonizing the processes itself, because we are seeing, there are a lot of opportunity, and we drive those to decarbonize ourselves. So I'm sure lot of, I interact with lot of those tech entrepreneurs, specifically now in the AI, to help companies to take faster decision based on the real-time data and information, so that their processes are more efficient, and therefore the transition can happen in a much better way. So I am definitely seeing their role as a growing important role in supporting and enabling the transition faster. So yes, they have a role.
Absolutely. Absolutely. In fact, I want to also add a point here. I mean, how do you utilize AI to speed the process of climate finance? And I think one of the classic examples is what we are doing at Octa CSG currently. We're developing a climate risk assessment platform, which is AI backed for credit and risk officers to be able to price the risk. So today what is happening is that there are multiple climate related platforms, risk platforms out there, which are giving you data in terms of heat maps and in terms of scenarios. But what the banking fraternity wants is literally about how am I going to price my risk? And that is what we are working on. So I think AI has a lot of opportunity in terms of products, in terms of fintech, in terms of the applications. One should look at how do you utilize that to be able to fasten the transition and fasten the climate finance that is required. So I think we are time up, and we are a very efficient group of people, I must say. So thank you very much. I think this was a very interesting conversation, and thanks to each one of you for bringing different perspectives, giving practical solutions to the thoughts or the challenges that may come out in the minds of people who are transitioning, who want to get onto this path. In fact, there is a very interesting report that Octa CSG with the Asian Bankers Association came up with, and this is for the how to do your transition planning for banks. So, I'll get one of my colleagues to put that in the link. Please pick that up. But that is literally telling you about what to do if you're a banker. But otherwise, thanks everybody. This is fantastic. And over to our Shantanu to close the session. Thank you very much.
Thank you, Namita, and a big thank you to all our speakers. For such an insightful discussion. I'm confident this session has helped us keep, our understanding of a collective understanding of this very critical topic of climate transition planning. And before we close, I'll just take a couple of minutes, 1 or 2 minutes, to pick up from where you talked about the AI-based tool that Octus is developing, Namita. I think that's catering more to the financing institution side of things. At IIFA South Asia, we're also developing a similar tool for the corporates, specifically the mid and small size, mid and small cap corporates in emerging markets, which is going to be a free web-based tool and essentially aimed at helping corporates visualize what does transition planning actually entail for them. So it's going to include a few data inputs from corporates, such as their current GHG inventories, their GHG targets, their decarbonization levers, and it's going to help them see, okay, based on my current levers, my targets, and my inventory, how well am I aligned to my decarbonization goals. And it's going to help them also pick up new levers from a top down, which they can choose and see what other options for their particular sector are available for them to decarbonize. It's also going to give them option to select different scenarios and see within different scenarios how does their decarbonization look like. So I'll be very happy to share that. It's still in the works, but I'll be happy to share that with this group and to all the other attendees that are here with us today. And with that, thank you so much, everyone, for being here, and wish you all a very happy weekend.
Thank you, and bye-bye. Thanks a lot. Thank you, everybody. Bye-bye. Thanks, Alistair. Bye-bye.
Bye-bye.